So before I completely dive into Dave Ramsey's psychology and why he might be wrong on a couple of these things, you must first know Dave's story. Now, at the time of making this video, Dave is a little bit of an older gentleman, but when he was 26 years old, he was bringing over $250,000 per year. And on top of all that, he had a $4 million investment portfolio tied up in real estate. And then just 2 years later, he lost absolutely everything due to a market crash. Not because he was following his own advice, but because back then he was borrowing a lot of money in order to make these investment purchases. And today, Dave Ramsey's in his 60s and happens to have over $200 million. A lot of it has to do with book sales and appearances, et cetera, but he's very well known in the finance space talking about investments, portfolio management, and building wealth as a whole. And some of the most infamous things that he's known for talking about is how much he hates credit cards. Meanwhile, praising savings and lower risk investments like mutual funds, which I definitely have nothing against mutual funds, but we'll talk about exactly why some of his logic might be slightly flawed. So obviously looking back on his story that he had back when he was 26, what you might gather is that he was extremely over leveraged, built a good investment portfolio, so he knew what to do, but he might have just done it a little bit wrong. And that market meltdown caused him to fear debt entirely. But before you go and buy yourself a Dave Ramsey handbook, I want to talk about why it's actually good to have specific debt. And then we'll talk about the nitty and gritty behind his investment logic and break that down a little bit later as well. So for those of you who might have seen my other videos, you probably already know that having specific debt is good. The first debt that you want to have is having a credit card. Now, it's important to know that most people don't know how to use a credit card properly. They'll usually have a balance on it and make minimum payments. That is very, very bad, and that is why Dave Ramsey says do not get one at all, so you can then avoid that entirely. But what he forgets to mention is that if you actually learn to use that credit card like a debit card versus having a debit card, then you can also take advantage of the points that you get back, usually sometimes 1.5, 2%, and in some cards even 5% cash back on those credit cards as long as you use them wisely. And what that means is actually paying off the credit card before the next month's bill. Not only does it build credit, but it allows banks to see that you're trustworthy with money. But with Dave Ramsey's logic is, well, why would you want to show the banks that you are good with money if you don't borrow money from the banks? Well, in case of actual emergency situations, you want to have a way to borrow money, and credit allows for a nice cushion to do so. And in addition, it allows you to make investment decisions that you might not be quite there yet with your cash, but with leveraging your portfolio and maybe getting a very low fixed rate loan, you can actually create massive amounts of wealth, especially when it comes to real estate or just overall business. And that will actually allow you to speed up the process of financial freedom, which is something that we're all aiming for. Now, I'd like to play devil's advocate. So in this case, I'm going to play Dave's advocate, and I totally understand where he's coming from when he talks about safety and also having that comfortability of not worrying about paying off your credit cards or having debt in general. He's a person that preaches to live below your means, and that will allow you to have financial freedom. I don't think that that's necessarily a bad thing. In fact, if you don't know how to use credit cards properly, or you're bad with money, or you have maybe a gambling addiction in the family, well, maybe credit cards aren't for you. And maybe Dave Ramsey's lifestyle is a little bit more of your style. But debt aside, you still need to invest your money in order to become financially free and wealthy. So that way you could retire either on time or hopefully early. But let's talk about what Dave Ramsey wants you to invest into and maybe why that's a good idea or not. So these are the things that Dave Ramsey says to either invest or not invest in on the screen here. So when he says invest in mutual funds, I do agree with him there. But one thing that he doesn't mention in any of this are the fees that you're going to pay with most mutual funds. Some of them have returned amazing results over the long course, but it's very hard to predict what these mutual funds will return in the long term. And he also mentions that real estate is a good investment, but he emphasizes that you should have it all paid off in full, which is another thing that I don't believe is necessarily true or holds up in today's time. I mean, obviously, you want to have enough cash or available investments and all of your other debt paid off if you're going to be buying real estate and having a real estate portfolio as a whole. And to be really taking advantage of real estate opportunities, you want to be buying houses in great neighborhoods, but buying the worst one on the block. And if you can, buying it for a discount. Obviously, then either renting it out, or if it needs some renovation, renovating it, then renting and allowing it to cash flow for you. Now, this is where Dave Ramsey had a little bit of a mishap where he over leveraged himself and his debt. And when the market ultimately ended up crashing on him, he wasn't able to pay off the debt, or he didn't have enough assets that were liquid that he could save himself from bankruptcy. So if you can handle the risk and you have enough assets that are liquid to be able to handle some debt, and you want to get in the real estate market, well, all those things can happen and you don't have to use your own hard-earned money. In fact, when you only use your hard-earned money and you pay it off in full, yes, you don't have that risk, but it definitely slows you down to your path of financial freedom. And of course, if you never got credit cards like Dave Ramsey says, well then of course you want to have all your real estate paid off in cash up front, because you won't be able to get a good rate on your loan. Banks won't trust you with money, and then you're just going downhill into the Dave Ramsey formula, not because you necessarily want to, but because you have to. So creating those good habits now is really, really important. So that way, if you wanted to take a little bit more risk in the markets when it's a good time, especially if we do see a market crash, then you can do so and you don't have to use your own money to do that. And just because he had one bad experience with that doesn't mean that there aren't a lot of other people that have had great successes, but their timing and their strategy was much better. And now some of the other things he says not to invest into, which for example is individual stocks, I highly disagree with him, because I believe that there are a ton of unrealized opportunities out there in the market, especially when it comes to individual stocks, which mutual funds don't typically pick up on until it's a little bit too late, or they just never do it at all because of the increased risk. And when we're talking about building wealth in our 20s, 30s, and 40s, you kind of want to have some degree of risk depending on your tolerance, depending on your income and other variables. And when we're talking about making investments in the stock market, you have to pick individual stocks in order to have that risk. And if it's not that, then you have to at least have ETFs instead of just mutual funds. And if you wanted to do that, Dave Ramsey says no to that as well. And another big no that I also disagree with is the fact that he says do not invest in Bitcoin or cryptocurrencies as a whole. And although I do agree with him to the fact that most cryptocurrencies won't see the light of day in the next 10, 20 years, there are plenty of crypto platforms and tokens that will actually end up revolutionizing the way we interact with either ourselves or the internet or the physical environment as a whole. And Dave, just because you don't understand something, don't tell other people to not explore that industry, because it is very, very young. Although right now, because it's not regulated, it is very easy to hop on a bandwagon of a crypto coin that you might have never heard of and then lose some of your investments. And then of course, regret that decision. But if you do the due diligence and you do the research and you subscribe to this channel, well, then you might be a little bit more educated in that space. Then you might want to take some risk out of the stock market or out of the real estate market or out of gold and silver and maybe put it into another asset. And one of those might just happen to be cryptocurrency.